Welcome everyone to our session today. We will have a very practical and useful webinar on stock options. Presenters will be Jason Cheng from PwC and Steve Lucas from Harper Gray. Both Harper Gray and PwC are very loyal sponsors of Angel Forum. So we're very, very pleased to have them here. I just wanted to give a brief intro on Angel Forum. You might not all be familiar with what we do. Basically, what we do, we connect promising startups with accredited angel capital. Angel Forum is a not-for-profit member organization of just accredited investors. So how do we make that connection? Well, we do that through the organization of events. Now they're all virtual. They vary from like bi-weekly checkups with the community to summits. We will have a summit upcoming. We call it the Whistler Summit. That's next week. You can check it out on our website. If you're interested in attending, please send me an email. In addition to our events, we also organize workshops like these because we really, really value sort of the educational part of early stage investing as well. So keep an eye on workshops that we still have coming for the remainder of this year. Founders, if you are interested and think you're ready to pitch to our accredited membership, please let me know if you're interested. Go to our website. We do accept applications on a rolling basis. Just check out our website, what we do require from your side. And investors, if you are interested in attending, just drop me an email. So that brings us to today. These are our sponsors. PwC and Harper are right there. And I welcome you to our webinar on stock options. I'm going to stop sharing my screen and I will go to my presentation for Jason. Can you see all this, Jason?
Don't see anything yet.
Okay, well, that's no problem. Then I'll share my screen again. There we go. Hi, Steve.
Hello, can you actually hear me? I'm a little nervous.
I can hear you. Yeah, no, we all are. I see you really well. So now I'm gonna share the screen. So Jason, if you can get me a cues when I need to switch to the next one, let me know.
Sure. Yeah, I actually don't see the screen. Oh, actually, no, it's coming now. Okay, perfect. Yeah. Maybe we'll start with some quick introductions. So I'm Jason Cheng. I'm a partner at the local Vancouver PwC office here. I specialize in tax and government incentives, so that would include SR&ED as well. So generally, I deal with technology clients, and I help them from the startup phase to the point where they're kind of exiting, whether it's through IPO or through a sale. So you know, I've been in taxation for, I'd say, about 25, 30 years now. So you know, I've seen a lot of things over the last 30 years. Previous to working in public practice, I actually spent a few years at the CRA too. So I've got that background as well. So that comes in useful most times when there's risk management issues. So Steve, want to do a quick intro?
Oh, perfect. So I'm Steve Lucas. I'm a lawyer at the law firm of Harper Gray. I've been practicing about the same length of time as Jason has, a little bit more, just a little bit grayer as well. My practice is corporate commercial, corporate finance. I do a lot of, my firm and I are both involved heavily in the startup field, emerging growth. We like working with founders and helping them develop their company, go through those financing and growth stages with them, dealing with advice and issues that arise in the governance model with the directors and the shareholders, employees, and so on, and ultimately helping everybody grow through to that exit. We tend to be founders oriented rather than investors oriented, and like working with that group of founders in order to get all the way through. We'll be focusing on stock options throughout today, really garnered towards very private companies, early stage companies. We're not going to be talking at all about companies that are listed on the exchange and so forth. It's a completely separate beast. And both Jason and I have a tendency to fall into some lingo here, and you will hear us using abbreviations and all sorts of contractions in terms of art. And please, if we use any language or there's anything we say throughout the slides that don't make sense to you, you are not being naive or silly. Please ask the question as soon as you can, because you're not the only one who will be wondering what we're talking about. We're going to try really hard not to do that, but as we get into it, I think you'll see us slip. Jason's going to go through the first part of the presentation, and then when he's done, I will finish off my slides. I have a tendency to interrupt him on an ongoing basis. Think a little bit about last night's debate. I won't be quite that bad, but I do tend to interrupt from time to time. And so by the end of the entire presentation from PwC, I will have covered off lots of my stuff.
Yeah, and I'm not going to bring your family into it, Steve.
And we count on that, Steve. We really count on that. Okay, Jason, are you ready?
Yeah, I'm ready. So just, yeah, as Steve mentioned, we're going to try to make this as interactive as possible. This is kind of a different experience for us. We're usually in person. So yeah, any questions, we're going to try and pause in between slides, and Irene will kind of, you know, post the questions as they come up. So the first thing we're going to talk about here is the agenda for today. We're going to talk about the different types of equity compensation, plan design considerations, the basics for employees and the basics for independent contractors. And we're going to talk about, you know, the different types of equity compensation you could have. So that would include restricted shares, share units, share appreciation rights. It's a very complicated piece of taxation. So we've kind of tried to make it as simple as possible here. So, you know, hope, you know, if you do have any questions, you know, feel free to post them anytime you want. Next slide, Irene. Okay, so so this is so what we're trying to get here is, you know, there's numerous types of stock option plans out there. So they're very complicated, but you know, they all kind of a variation of one or the other, right? So the key point here is that employers need to understand their own plan, because there's a lot of nuances of each plan, and you have to know the details of what's going on in each plan. So so some of the general ones are, you know, you obviously know that you can grant stocks, you have stock options. Those are very common. Then you got this category of what we call phantom stock option plans and share appreciation rights. Those are plans where you don't actually get shares of the company, but you get notional shares, and any appreciation that comes with the value of those shares, you will get a payout at the end. So usually in the form of cash. But then it could also be that you do get shares in lieu of the cash you should have got. So then yeah, so yeah, this is quite a bit here. I'm just gonna pause a bit. I don't know if anybody has any questions.
Well, I will pause you when there are questions. So just keep going, and then
Okay,
I'll be with
yeah.
you, and then we'll do the questions.
Okay, next slide. So this one is page 4, plan design consideration. So Steve, you want to cover this one? Do you want to cover it now, or do you want to cover it later in your slides?
No, I'll deal with it later as we get into to mine. I think, you know, since I've opened my mouth, just to state the very basics for everybody who's watching, you know, a stock option, I think we just need to take a second and explain what it is and make sure everyone understands. And all what an option is giving somebody the ability to buy a share in your company at some point in the future at a predetermined price. So it is not giving somebody a share. It is not selling them a share. It is giving them the ability to buy that share at some point in the future. And then there are all sorts of bells and whistles attached to that. And I'll cover that off later on when we get through the taxation stuff.
Yeah. So yeah, in essence, it's a right to purchase a share. Or okay, so next slide, advantages. So so there's the major advantage to a stock option plan is that it's very, you know, it's very simplistic, right? You know, if you're an employee and you perform well, the employers want to reward the employees and give them stock options, the right to purchase shares later on. You know, the biggest tax advantage to having stock option plans, especially if you're a CCPC, which is a Canadian Controlled Private Corporation, essentially CCPC, and you know, it's a long definition in the Tax Act, but essentially, if you were to look at all the voting shareholders, all the votes in the you know, in your shareholder base, and if you look at the non-resident holdings and you look at the public company holdings, if they don't sum up to more than 50%, you're probably okay. That's the de jure control. There's another control called de facto control, and if there in fact is controlled by one of these two parties or a combination of these parties, then you could fall offside. So it's if you are CCPC under tax law, you do have preferential treatment, preferential benefits, and one of them is, you know, we're going to talk about here for stock options. You get a deferral of taxation of these options. The other things you probably already know. There's enhanced shred credits. There's a lower corporate tax rate, and then another one we're going to talk about later is the enhanced capital gains exemption.
So there's lots and lots of reasons why you may want to be a CCPC. And again, you know, there are entire sessions we could do just on the details of that qualification. And I think, you know, for the purposes of this and for the people who are listening in, you know, what's important about it is if you start issuing shares to people who are not private individual Canadians, be very cautious about what you are doing and who is getting that stock, because there is this mathematical calculation that needs to be done, and it isn't just black and white. But you want to stay a CCPC as long as you can to take advantage of a number of these tax advantages that are out there.
Yeah, and just to add further, it doesn't even need to be issuance of shares. It could be issuance of a right to purchase shares. That could put you offside. Some of the disadvantages, so obviously, you know, you're going to dilute your shares, dilute your holdings if you start issuing shares out to employees. But then, you know, you don't get corporate deduction either, right? So it's all, most of the time it's issued from Treasury or it's cash in lieu. You know, there's a perceived lack of alignment between the employee interests and the employer interests. The employers are always thinking about long term, and employees are always thinking short term. You know, what have you done for me lately, right? So, so that's a disadvantage, and yeah, it's just trying to balance between the two. That's usually how I put it when you create a stock option plan. Next slide. Okay, so so when we look at stock options, so there's three relevant dates. There's the date of the grant, date of exercise, and then the date of sale. Those are three relevant dates. So the taxable benefit obviously would be your fair market value exercise less your exercise price. So whatever comes out to be your taxable benefit based on that formula. If you're CCPC, you're taxed at the time of the sale of the underlying shares, provided you meet the criteria. Everything else is taxed at the date of exercise. So this is a huge advantage, because if you may exercise the shares while still working at the company, but then the company may go IPO in like 5 or 6 years afterwards, and then you sell the shares at that point in time, the benefit is taxed at that point of time and during the sale of the shares, as opposed to when you actually purchase the shares. And we've got a note here, FMV, fair market value, is just whatever the going rate for the shares are at that time, what they're valued at. Next slide. There's also a 50% stock option deduction available for employees. If you're CCPC, if you hold the shares for 2 years following the exercise of the option, you get a 50% deduction. And that 50% deduction is to mimic a capital gain tax treatment. I don't know if you guys all know, capital gains are taxed at 50% of your current tax rate. Anything else, every other, all stock options, in order to qualify for this, your exercise price has to be at least the fair market value at the time of the grant. It needs to be arm's length. So the employee needs to be arm's length, meaning that they can't be related to the shareholders of the company. And it needs to be a prescribed share, and the prescribed share is generally just a common share. Have a note here, there's a new proposed legislation for stock options issued in 2020. That has not passed to my knowledge. We're going to talk about a bit more on slide 19, but the good news is it doesn't affect CCPCs. It only affects non-CCPCs. Okay, next slide. Okay, we're just going to go through an example here. So if you had 1,000 options to purchase 1,000 shares, you get it in year 1. The exercise price is equal to fair market value of the grant at the date of grant, $10 a share. So in essence, $10,000 would be your price that you pay. So year 2, you exercise those options, and the fair market value at that time is $12. So it's gone up $2 a share. So you pay $12,000 for those. So it's the fair market value is $12,000, but you only pay $10,000. So there's a $2,000 benefit there. The question is, when is that benefit taxed? If you're a CCPC, it's taxed in the year that you sell the shares. So if you don't sell the shares for 10 years, you tax them 10 years later when you actually sell the shares. If we go further here, if we go to the next slide, I think that it actually has a table that.
Sorry, just before we get there, Jason, again to be very, very clear about this, because the mathematics will get complicated if people don't follow it. But remember, the process here is when you have an employee or a participant in an option plan, you grant them the options, meaning you've given them the right to buy these shares, and it's at fair market value, so they get the right to buy the share at $10, just as Jason explains. The next step at some point in time is to exercise those options, meaning the employee, as the case may be, will pay the money to the company to buy those shares as granted under the option. So they would pay the $10 per share in order to exercise the options. They then no longer have that option. They own shares just like everybody else. And then eventually you want to turn around and sell those shares. And that's what Jason is talking about in year 5. We come back, as odd as it may seem to a lot of people, is when you exercise that option and you buy a share that's worth $12 for $10, you have a $2 windfall there. You have a $2 gain. And you will have to pay tax on that $2 gain, even though you haven't received any money. But if you're a CCPC, you get to defer that gain until later on. And again, Jason's going to go through this in more detail. But you need to appreciate very distinctly those steps that Jason has outlined here between a grant, an exercise, and the sale. And part of it because of the CCPC test, and part of it because of the fact that employees tend not to have the $10,000 sitting here to exercise an option early. The exercise and the sale tend to happen at the same time. But that's just the way it turns out, not the way it has to happen. Okay. And so there are people who will exercise options early in order to get that 2-year runway. There are people who will exercise options early in order to make sure that they have those shares when the time comes, and so on. So please remember these very distinct steps as we go. Sorry, Jason.
Yeah, that's great. We actually have, next slide, we actually have the numerical example there, kind of all laid out. So it should be much clearer once you guys see this. So we mentioned the exercising of the options happens in year 2. So if you're non-CCPC, that gain gets taxed right away at the time of exercise, so in year 2. But if you're CCPC, that actually does not get taxed until the year you actually sell the underlying shares in year 5. So that $2,000, and when you net out the stock option deduction, $1,000 gets taxed in year 5. Also, the other thing to keep in mind, because you're selling the shares and the shares has gone up to $18, there's another $6 gain per share. So that $6 is a capital gain, and it's taxed at capital gains rates, which is 50%. So that $6,000 that you would have been taxed normally at full rates is only $3,000 gets taxed at full rates. And if the other thing that if the beauty of a CCPC, you may also qualify for capital gains exemption, which means that you don't actually even have to pay tax on that $3,000. And we're gonna talk about that in the next slide. How do you qualify for the capital gains exemption? Next slide, Irene.
I just have a question, maybe for the audience. Look at Steve or Jace, but maybe Steve, you'll probably address that in your presentation as well. Can you define what a CCPC is and what makes it?
I think Jason covered much of that in his comment. But remember, a CCPC, just to paraphrase his comments, is a Canadian-controlled private corporation. And I'm going to completely bastardize the rules here, so forgive me. But a CCPC is a company that is, and pardon the double negative, not controlled by non-Canadians. And so if we were being a very lay in our discussion, it would be a majority of your shareholders are Canadians who are not public. So public companies are bad guys, international investors are bad guys, you do the math. But the reality of the test is it comes down to who has the ability to elect a majority of the board of directors at any given point in time. And so again, you align these pluses and minuses between people who are individual Canadians and people who are not. But as Jason commented on earlier, you also need to take into account people who hold options and warrants and convertible debt and any other convertible security that may at any point in time convert. And you have to count all the bad guys and none of the good guys in those convertible securities. So the government tries that the test is set up to look at the worst case scenario, okay, the worst situation from being Canadian controlled. And you need to run that math on an ongoing basis every time that you issue or exercise convertible securities.
Okay, thank you.
Okay,
I'll get back.
One last comment on that is, it isn't even, I'm going to say, as simple as that. If you have a shareholders agreement in place and your American VC, for example, has the ability in order to elect 3 directors where the Canadian founders can only elect 2, you will not be a CCPC. So again, it comes down to, is there a mathematical, contractual way in which non-residents can basically dictate who runs this company?
Yeah, and this is a very complicated topic in tax law. It's always hits the courts. CCPC status is probably, if you do a Google search, it's probably all contested all the time.
Okay, so that answers your question here, Connor, regarding the USVC money. I'll get back to your second question later. Just very quickly, are permanent residents Canadians for the purpose of CCPC, Steve?
Yeah, I'm going to try to answer this, and then I'm going to ask Jason if I'm right. But the answer to that is it doesn't matter whether you're a permanent resident or not. It matters whether you're a Canadian resident taxpayer.
Yeah, exactly. You have to be a resident for tax purposes. So if you are a resident for tax purposes and you own those shares, then you're considered one of the good guys.
Okay.
And no, Connor, a board control isn't enough. It's the start. If you have board control, it looks good off the get-go. But if there is any way at that moment in time you can lose that board control, then you're not good.
Okay.
So if your agreements or whatever have a default mechanism in them that says if something happens, then the Americans can move in, and I'm going to pick on the Americans again. It could be Americans, it could be public companies, could be any international individuals. But if there's a default that they can move in, if there's a conversion situation that could allow them to get control, you're offside.
Yeah. And then just one further note on that, quite often what I see with startups is there's a lot of shareholders that come from abroad, right? So they're not Canadian residents at the time, but then they become Canadian residents for tax purposes as well, right? After they enter Canada. And but then sometimes what I do see is the shareholder register actually still shows the shareholders' other country as the place of residence. If that is the case, you have to change that ASAP, because if you don't change that, and CRA asks, they always ask for the share register. They see a foreign address on there, they automatically assume they're not Canadians, not Canadian residents, until you prove it. And try to prove when that actually happened is a bit of an uphill battle. So it's best to kind of make sure your ducks are in line before you actually give them a shareholder register.
And one of the other things about it too, folks, is a CCPC isn't like scrambling the egg. You can not be a CCPC one day and then fix your problems and become a CCPC again the next day. It can go on, and you can go back and forth depending on international control and voting rights and so on in a company. So it's a snapshot in time test, and it's important that you again be CCPCs at that time.
Okay, shall we continue?
Yep. So next slide.
Yeah.
Okay, so we mentioned capital gains exemption. So if you're a CCPC, you may qualify for this. If you're a non-CCPC, you definitely don't qualify for capital gains exemption. So in order to qualify for capital gains exemption, the current maximum that you get lifetime is $883,384 that of capital gains that you will not have to pay tax on for your lifetime. And this amount gets indexed every year for inflation. So it used to be 800,000 back about 5 or 6 years ago. It's gone up to 883 now. So in order to qualify, you have to dispose of shares of a QSBC, qualified small business corporation shares. So essentially, it's a CCPC shares, which has extra criteria that they have to meet, and generally it's 3 criteria that you have to meet. Okay, first one is you have to be a CCPC where substantially all of your the fair market value of your assets are used principally in the active business income and carried on in Canada. So there's a few words in there that's going to be a bit messy here. All or substantially all usually implies about 90% or more of the fair market value of the assets. So you have to figure out what's the current value of your assets, and it needs to be principally used in the active business carried on in Canada. So principally is 50% or more, and then active business carried on in Canada would it has to be the best way of saying qualifying what is active business. Active business is usually something you have to get, you have to essentially do something to earn, versus passive income is something that you don't actually do much to earn. And so it'd be like collecting rents or royalties. That's passive. Active is you have to actually do something and get out of your chair to actually make that money. The other 2 tests You actually have to own the shares for 24 months before disposition. Within that 24 months, you have to meet a 50% test. The 50% means that 50% of the fair market value of the assets are used in the active business income carried on in Canada. There's also a 90% test at the time of disposition. You have to meet that as well. So 90% of the fair market value of assets has to be used in the active business carried on in Canada. So the main point there is that 90% test is a higher threshold, and a lot of companies may not make it if they have a lot of what we call passive investments in their balance sheet. So if you have a lot of GICs or portfolio investments, that may put you offside. So what we recommend to clients is that if you're thinking about selling and thinking about using the capital gains exemption, we have to kind of make sure you fit the rules. And one of the things we typically tell clients to do is, get rid of those assets, right? Those bad assets. Lots of ways of doing it. You can move it to a different company. You can sell it. Just get it off the balance sheet, right?
This is kind of this aspect on the capital gains exemption, everybody, is far beyond stock options. It applies absolutely for the sale of any shares, in your company. So whether you're the founders with your founder shares, or whether you're an angel investor and selling your A's, B's, and C shares, whatever it may be, the same test applies throughout that entire process. Obviously, it applies to stock options, or the shares that are sold upon the exercise of the stock options. Again, to be clear, it's the shares sold upon exercise of the stock options that we're talking about. But these tests are really, really important. And where companies accidentally step offside is, if you've had a successful company and you're very conservative managers and you've been aggregating cash in your company, you may accidentally be offside because you have too much money. And as Jason says, you can fix that by paying dividends or doing other things before you sell. But if you rush into an exit without having proper accounting and legal advice going through these things, you may end up losing that ability to claim that capital gains exemption. And for people who are not serial rich guys with lots of successful exits, it is a material amount of money that you would be giving to the government that you don't need to give to the government. The other thing that Jason mentioned, and I want to emphasize, is the 2-year rule, which requires you to have held these shares for 2 years before selling them in order to be able to use the capital gains exemption. And if you have a stock option and you don't exercise it until right before close, while you can still get capital gains treatment on the sale of your shares, you will not be able to use the capital gains exemption. And again, it's still good money, but you will not have that exemption in there. So for those of you who are holding penny options or options to buy shares at a very, very low price, and it looks very likely like there will be an exit at some point in the future, you may wish to exercise those options sooner rather than later in order to try to avail yourself of that 2-year hold period.
Yeah, it is, as Steve mentioned, it's a substantial amount of money. You think about 883,000. The capital gains exemption will apply to any individual. So if you have a large family, you can actually multiply this throughout the members of your family. So if your spouse is eligible as well, and your kids, if they're of Asian majority, can actually capitalize on this as well too. The last point there on the A bill, that's it's probably not relevant for most people, but it's just it's just a note there. Next slide. So stock options, they're usually settled treasury shares. So that means shares that are kind of brand new shares that are issued. So they're not existing shares. But then sometimes they are settled with cash if the employee decides to take cash in lieu of shares. If that's the case, the company is eligible for a corporate deduction, but they can elect to not take it. So if they don't take the corporate deduction, what happens is that the employee will be eligible for a 50% deduction on their benefit. So essentially, the company would have to give up the right to that deduction for the employee to get the 50% deduction. If the shares are issued from Treasury, nothing really happens tax wise. There's no corporate deduction because there's no real expense. Next slide, Irene. So the one of the things that always comes up, and the question comes up is, when employees actually have their stock option benefits, do we as employer need to withhold taxes? And the answer is yes. It is reportable if you're non-CCPC. But if you're a CCPC, there is a special exemption that you do have. The employers don't need to worry about withholdings on those benefits because the practically they won't actually nobody ever keeps track when the employees actually sell the underlying shares because it could happen 10 years, 20 years on the road, who knows, right? So it only applies for non-CCPCs, the withholding taxes. And the employee, it's just regular employee. It's just a regular withholding taxes, assuming kind of on the same lines as if you issue a bonus to the employee. So it's treated the same way. Next slide, Ernie. So we covered a bit of this already. So it's actually same. So you withhold the tax in the same period the stock options exercise. So when the benefits actually it gets incurred. A lot of times, it could be quite a bit of withholding, and employees may not have the money to actually pay it right away through their regular salary. So what employers usually do, or what they can do, is they loan the money to the employee, and then kind of slowly take it off of their regular salaries throughout the year. Next slide, Irene.
Remember as we're going through all of these too, that we're talking about employees exercising options and all the good and bad that can come from that. But remember, just because you exercise an option and you cut a check to the company, whether it's cash settlement, as Jason says, or payroll deduction, or any of these other methods, if the company never exits, or if the company fails in the future, or if there is a down round where people are buying in at a lower price, okay, these employees are going to suffer some sort of potential tax consequence, and in any event be out of pocket just as any other investor would. So both the company and the employee needs to understand that what they are doing in exercising these options is they are investing in the company just as any other outside investor is. Tax aspects aside for a minute. And you may end up with, we can talk about it later in the structuring of the plan. You are going to end up with new shareholders who used to be participants in your stock option pool who are now shareholders. So it's you got to watch the tax. There's no guarantee of success. And what happens very often in the practical reality of the world is we come to the exit, and it's a really nice exit, and we're at the last few minutes of working through this, figuring out how we're going to deal with all of these stock options that are out there. And so, notwithstanding what people's expectations are about settling their stock options, it's very difficult to go to somebody and say, you need to put up $20,000 to exercise your options in a week so that we can give you $50,000 on the sale of your company. It's a big win for your employees. It would be nice to do, but they often don't have the $20,000, and they often end up in a situation where all of the expectations going through these benefits, deductions, and so on, doesn't come to fruition because they end up just selling their options rather than selling their shares, if that makes sense.
Yeah, yeah, it's all cash flow considerations. You actually, a lot of times you actually don't, like Steve was saying, you don't actually get the cash until a few years later, but you have to pay the money up front. So next slide. Okay, so we're in independent contractors. Okay, so the simple answer to this is independent contractors don't have stock option taxation benefits.
So Adrian, you've gone one slide too far. Can you back up one?
Yeah, we're on slide 14. Yeah. So essentially, if you issue options to independent contractors, there is no preferential taxation treatment. So whenever they get the options, it's considered business income. The question always comes up, what's the value of those options? And Steve, I know you love to talk about this, so I'll let you talk about it.
Well, I like just generally watching the look on independent contractors' faces when you explain to them that if you're awarded stock options by a company, you can't just put them in your pocket and walk away, that you do have a taxable event at that point in time. And that's what's important to those of you who are independent contractors. And let's just down curtain for a minute and have a little chat about an employee versus an independent contractor. Again, there are many sessions done just on what the difference is between an independent contractor and an employee, and I'm not going to go there. But what people need to appreciate is all of you who are founders and have started up your company, I have no doubt, have said, oh, we're paying these people as contractors, not as employees. The reason startups do that, amongst many other reasons, is you don't need to withhold, you don't need to do deductions, you don't need to go through the bookkeeping, and you can pay people less money because, in effect, they're getting all that cash in their pocket off the get-go without that. Contractors, you've eventually got to pay tax on the money you earn. It's just a time value. And if you're in the lower income brackets, it may turn out that you don't need to pay any significant tax. And so rather than waiting for your refunds, you choose to take the money. So you operate as contractors. But if you're awarded stock options at an early stage of the company and otherwise, and part of those options are compensation to you in your capacity as contractors rather than employees, you're in a slightly different mess. So I digressed into that section just so you understand that the concept of a contractor applies off the start. It applies during the middle and later stages of the entire company life cycle, and in particular, the option plan. So your plans, and again, we'll talk about a little more in detail, will allow you to provide option consideration to your contractors. And when they get those options, there is a value. So if your share is worth $10, to use Jason's number earlier on, and you grant me as a contractor an option to buy that share at $10 being fair market value, right? People would argue, and most of the experienced contractors, if their jaws are still hanging, are going, but there's no value to that. If I exercise it, I get a $10 share for $10. There's no value. And I can buy that argument if you were to exercise it today. But if you were to exercise it when it's $12, clearly there was a $2 value that accrued. You couldn't see it at the beginning, but it's there. And so I can also buy, who the hell knows where it goes, it may be worth nothing. But if you had 1,000 options to buy shares in a company at $10 at its fair market value, I would pay you $1 to take those options off your hands. Okay, I'd like to pay $1 to have that upside ability later on. I'd pay you $10. I'd pay you $100. Okay, I don't know at the end of the day on any company specific option setup what I would pay you, but there is value to those options, okay? And that's the value that you need to get taxed on.
Yeah.
Jason?
Yeah, yeah, and that value that you get taxed on is considered business income, so it's not you don't get any preferential tax rates on it. If you do if you do exercise the option and you sell the underlying share later on, what the difference between your exercise price and the actual eventual sale price, that is considered capital gain. So you do qualify for the other things. So you would get the capital gains preferred tax rate, and you may qualify for the capital gains exemption if you meet the conditions. The thing that I'm going to emphasize is there is no 50% stock option benefit for contractors. So that's definitely a no. Let's go to the next slide, 15.
Can you, Jason, what about directors? Are directors considered contractors or employees for all of these rules?
It depends. If they're on payroll, it would be a question of fact, really, right? A lot of times directors are shareholders as well, and they actually actively participate in the company. So they would probably draw a salary as well. Yeah, and I hate to say it's a question of fact, but it varies from company to company.
And I think that's probably again the takeaway point here is people who are being provided options as directors, okay, may or may not get the benefit of the preferential tax treatment that's afforded to employees, as opposed to the penal treatment that's afforded independent contractors. And again, if you're being compensated in options as directors, you should give some good planning thought to exactly how that's structured to maximize the likelihood you'll get the upside and not the downside.
Okay, and let's move on to slide 15 here, restricted shares. So restricted shares are they're the actual shares that are granted to employee, right? So they're not options to purchase shares; they're actual shares that are issued. So the taxable benefits that you get taxed on is the fair market value of the shares at the time you receive it, and then there's and you get the stock option deduction if you hold if it's a CCPC share and you hold it for 2 years, and then stock option deductions are not available for any other situation. I don't know if you have anything to add to this, Steve.
I'm sorry, I was distracted by replying to a Richard Miller a note that I was having too much fun with. Go again, Dave.
Okay.
I missed the question.
So was that Steve?
I missed your question.
Oh no, do you have anything to add?
No, that's not around the restricted shares. It's we're used to seeing common shares as the basic underlying reward for these items, and it's so rare to see anything other.
Yeah. Okay.
Next slide.
Okay, next slide. I see an interesting question. How do you value option in a private company? So I see that's answered by Richard Miller. Okay, well, that's the one you're replying to there, Steve.
Yeah.
So I don't know. Long and short, it's a complicated process. There's in an audit environment, there's the Black-Scholes model that they try to employ. It's a very complicated formula, which I don't think anybody really knows it's all. So it's a very complex question how do you value option in a private company. It's it could be a separate lesson or less separate session on its own. But if you guys, if Richard, if you want to really discuss it later, we can do it offline.
Yeah, look, I think my answer to it, Richard, as I said, I never want to be quoted back on it. It's an art, not a science on the valuation on that question. But we want to start with how do you value the shares of a company, and therefore how do you determine the fair market value of options when you're going to grant them? We go through those exercises all the time. You will see, again, depending on how the accounting works, and Jason, you'll be able to answer this part better than me, but I'll lob the ball back to you, is companies are required to accrue on their financial statements stock option compensation expense and so on. And so there's a whole other exercise that your accounting team goes through using the Black-Scholes model, which, as Jason alluded to, is, if you haven't heard it before, it's a convoluted, I'm going to say mathematical formula. It's half art to determine the values of these things based on all sorts of factors. Works far better in public companies than in private companies, but there are accounting methods to reach those numbers. Other than that, it's again, the art of valuation. It's give it a good college try. The chances are really good you're not going to be challenged on it, as long as there's some reasonable foundation that you have for coming up with those numbers.
Another question from Jeff. Nice to see you again here. He was here yesterday as well. For both of you, what is the current thinking trend about compensating an advisory board? 2 to 3.
Well, that for later, Jeff. I'll talk about some of the kind of numbers going through that I'm seeing when we get down to the plan itself.
Perfect. Okay, Jason.
Okay, so we're on slide 16, advantages of restricted shares. So obviously you have mandatory share ownership, which is if that's your intent, that helps put shares into the hands of the employees. It's more motivational because employees actually have something substantial. The value is there. They have the actual shares. It's not an option where they're wondering, am I going to make money off of this or not? With a stock option, you may be underwater, so if the value of the company is actually less than your exercise price, then you may not be motivated to do more to kind of bring the value up. There's the value. And the big one, there's a preferential tax treatment for CCPC shares. So we mentioned that as well. So when you get the actual shares, you get the capital gains exemption. Provided you meet the criteria. Some of the disadvantages, you don't have, there's immediate income inclusion based on the fair market value of the shares that you receive. The company does not get corporate tax deduction, and the employees don't really have what we call, you don't get the stock option deduction benefits or the taxation benefits that come along with stock options. Next slide, Irene. So just very quickly, RSUs, PSUs, and DSUs. So restricted share units, performance share units, deferred share units. They're all pretty well promises to pay. They're kind of variations of the phantom stock option plan. They a lot of times you have the option to take the what we call the amount in shares or cash, and it's taxed on vesting. So depending on the structure of the plan. Steve, you probably do tons of these every month. So
Yeah, no, exactly. And you never see them.
yeah. Share appreciation rights. So they're essentially they're phantom stock options. So they call phantom stock options is because you don't really get a stock option, but you get a notional stock option. And then if the
Sorry,
value.
we need next slide, Irene.
Yeah, it's okay.
Oh, we're at 18. Sorry, I'm on the five person on the screen page, so I can barely see the slides here.
We'll keep you honest. Don't worry about it.
Okay, perfect. Yeah, so share appreciation rights. It's a type of phantom stock option plan where you get notional stock options, and then at the end of the day, whatever value that you get out of it, you could get that in cash or shares. And then if you do get cash, you are taxed at settlement. It's almost like a bonus. And then if it's settled in shares, the company would usually issue from Treasury, so they wouldn't get corporate deduction. And then when you do sell those shares, you either get a capital gain or loss, depending on the price that you eventually sell them at. And if they're a capital gain, you may qualify for capital gains exemption. Next slide, Irene. We're getting close to the end here. Okay, yeah, I think this is my last slide. So current development. So we talked about the proposed legislation earlier that's proposed by the Liberal government. It's for stock options that are issued in 2020. So essentially CCPCs, there's no change to the 50% deduction, but there is a limit to non-CCPCs. So non-CCPCs, what they're proposing is that there's going to be a 200,000 annual vesting limit, in which the 50% deduction is eligible for. So it's based on the fair market value of the shares at the time of grant, but there is, there are some exceptions, but it's all being ironed out still. But just a FYI, it doesn't affect most of you guys because most of you are probably CCPCs. But it's nice to know that if you're non-CCPC, there's a $200,000 vesting limit annually. And again, it's proposed. It hasn't passed yet, so because of the minority government, I think things are being held up a little bit more than normal, and because of COVID. And I think that's it, right, Irene? That's the last slide. Yeah. Yeah, you'll see on the contact there. Ian Bates is one of our senior managers. I think a lot of you guys may have met him already. So if there's any questions on this, either call me or call Ian or Steve on the legal side.
I will make all your contact details available at the end again. And if people want to receive a copy of the presentation, please drop me an email. I'll put my email up again and I'll send you that this afternoon. So thank you very much, Jason. Steve, are you ready? Your presentation is up.
I'm ready. I want you, to know, Jason, I don't know, you and I have done this a number of times together, but I don't think you've ever actually left me with half of the allotted time.
I know.
I don't know what I'm really going to do in order to fill the next period, but we'll see. Just before I really move on, again, I'm kind of looking at the comment screen and it's a little quiet. If people want, we can take just a few minutes if there are any technical accounting tax questions, just while the topic is hot, because I'm certainly going to go in a different direction where I will only use the word tax a few times.
There is one question, and I'm sure you don't have any problem filling the hour, Steve, but that's just what I think. There is a question from Carolyn, and Jason, she's asking, restricted shares, can you elaborate on tax when shares sold for CCPC? Does that mean it's not necessary to inform CRA in the year the restricted vested shares are given? I think you sort of discussed this already, but
yeah, no, it's so when you do issue those restricted shares, you know, when the employee gets those shares, it is the fair market value of those shares are taxed at the time of receipt. You know, when you do sell it, you are eligible for possibly a capital gains exemption at the time of sale. So hopefully that was a part of that. Hopefully that makes it more clear.
I think just to kind of throw something else at you on that one, now that those ugly letters CRA has been raised, you know, we talk about the taxation throughout, but Jason, you know, I guess a contractor, because they're taxed on the value of the options when they get them, should report in their filings the acceptance or the compensation of those stock options. For employees, not necessary when you're granted options, even if you're not a CCPC, right? But can you maybe just kind of give us some guidance on really what, if you're going to be perfect, filings, what you need to tell the CRA when?
So I missed part of that, Steve. So, you know, I heard independent contractor getting stock options or share units.
Yeah, I'll rephrase it because it did take a while. If you are a contractor, in the year that you receive an option grant, you will need to report that in your tax returns, yes?
Yeah. Yeah.
And when you exercise your options, you need to report that in your tax return as well if you're not a CCPC.
I don't think it makes a difference if you're CCPC. I think you just report it. You know, it's a good question, and I don't think there's a differentiation based on my understanding of the rules.
Okay, and then obviously when you sell, you have a taxable event in any event. So again, it's a little bit of a mess, you know, all of these things, but it's if you want to be perfect with the CRA, what you do is you make sure that you are dealing with an accountant through these things, an outside accountant preferably, and that you fully disclose to them what's going on so they can provide you with that guidance based on your facts and your company's facts, okay? All right.
Good.
So let me get my machine to the screen that we're at so we can immediately move to the next slide on that one.
Okay.
So, yeah, Jason has gone over you know, most of these. I'm not going to drill down into what all these things mean, but you know, the point I want to make is that when we're talking about creating a stock option plan and designing a plan, there is some magic to it, but it can be created to achieve the goals that you want to achieve. You know, there are these different plans for reasons, and not everyone is right for you, and it isn't necessarily in your best interest to use the one you used at your last company, or to grab the latest one off the internet, or to go into a lawyer's package A and pick option plan B. All of these things are there for a reason, and they can work to help you and they can work to hinder you. And so it's important that you have this fundamental understanding on what these things are all about. Next slide, Irene. So I just want to start with the, oh, didn't move. There we go. Start with this. Why do you want a plan? Okay, what's the purpose of this plan? Is it really a reward for staying with the company? Do you want to encourage people to stay and stay and stay? And so you design a plan that way? Or do you want to reward people who perform really well? Or are you trying to use it in lieu of compensation? Are we trying to create a plan that encourages employee ownership, or a plan that kind of goes, I've got to give it to you, but we really don't want to? Is our plan going to be designed for everybody in the company, Or are we going to have a plan that is restricted to your C-suite, or is restricted to your development team or your sales team? Understand you can have more than one plan. You can have a plan that treats different people in different ways. So think about why you want it. And at the end of the day, please, this last point, what does management know about stock options and the impact on the company? You do not need a Rolls-Royce complex version of a stock option plan if the people who are receiving the options and the people who are dealing with it can't work it and don't understand it. Okay, next, Irene. Right, following on that completely, ooh, that's cool. There you go. You know, how much education support is required? Are you going to have to spend an excessive amount of time teaching your employees or teaching the people you're trying to reward what it is they're getting and how it's working? Think about how much ownership is appropriate. How much of your company are you giving away to employees at what level? Again, you know, we went through it before, but in giving an employee or anybody an option is giving them a piece of your company. And I say giving, it's selling them a piece of the company. They will eventually buy it, whether by way of labor or by way of deduction or by way of cash or by way of a forfeiture of a portion of the returns at the time of the exit. Okay, so what is right? How much of it is right? And all of these things need to be taken into account in deciding right off the get-go what this thing is going to look like. Okay, Irene, next. So to try to give some guidance on that, what you tend to see is about, you know, these are rules of thumb, they're not gospel, but you're seeing in a seed stage private company, 20 to 25% perhaps of the shares being reserved for issuance under these plans. As you grow, you will find those numbers shrinking. They shrink for a number of reasons, one of which is you've tended to issue more shares. So by decreasing the percentages, you tend to kind of stay at roughly the same number of shares. You have more people in the future coming into your company from a seed stage. You may know you need a variety of tech people that you're going to need to compensate generously by way of options. And as your company grows, there are fewer and fewer of those who aren't already part of the company. You will see plans that, you know, the question of evergreen. So if I say to you, I've got 10% of my shares subject to the plan, the question becomes, well, is that 10% of your shares now, or is it 10% of your shares at all times? So if I have 10 million shares issued and outstanding now, and I do a financing that issues another 5 million shares, does my plan automatically increase from 1 million shares to 1.5 million? Or do I need to come back and increase the size of my plan later on? If somebody exercises 100,000 options, can I reissue that 100,000 options now to new employees? All of these questions, there's no right or wrong answer to it. The reality is that you've just got to kind of work your way through what you are looking to do and what you are looking to achieve in order to maximize the use of that plan with you. Okay, next. So within your plan now that we've got, how do we decide who gets those options? How do we allocate those numbers out? And again, you'll see kind of some of the general rules of thumb on distributions from the option pool. Just let you kind of just skim through that. Again, every company is different, but you will see that on average, management takes about half of the pool. What you will see and what we'll talk about endlessly is whether or not founders should be entitled to any options at all. And again, while every company is different, the vast majority of companies that we see out there, the founders do not get options. The founders are appropriately and adequately compensated off the get-go through the issuance of their penny stock or their founder shares, as we tend to call them. And the fact that you have 3 million, 5 million, 10 million total issued and outstanding shares issued to founders at a penny a share suggests that they have enough compensation, they have enough motivation in order to avoid digging into the stock option pool. I'm just going to pause for a second to see if anybody has any questions there before we move on. Just
I don't think there's any new questions. No.
It's just kind of a logical gap. All right, so let's go to the next slide.
Yeah.
So we have this plan, we have it in place. You've heard us talk about it. So the initial decision to make is, what is your grant frequency? How often are you as a company going to grant options to people? And again, there's no magic to this, no rules, but you will tend to see that people get stock options when they are hired. So this is your receptionist example. You know, this is your controller perhaps example. People who join the company are looking for options up front. They will get a one-time grant based on when they come in. Or you can have ongoing and periodic grants. You can agree that you are going to grant people options every year. You're going to take a look at how they're doing and what they're doing, and you're going to end up saying, we're going to give you 100 options this year, 100 options next year, as opposed to saying 200 options off the get-go. The difference between doing it on an ongoing basis rather than at the start is really the exercise price per share. Because if we're granting it at fair market value, if you grant these options when people join, they're going to have the benefit of any growth from therein and bear the burden of any decrease in price from there on in. If you do it annually, that price will change and you will have a different exercise price for the new options on an ongoing basis. The one-time grants that I have listed here, again, you can have people who are entitled to options and you say you will get an option when you achieve some goal. You will receive your options when when the company raises $1 million. You will receive your options when the alpha product is ready to go, and so on. So again, you can do this. You can create these plans to meet your needs and your desires and your motivation. And it all comes back to the start, which is, why are you doing this in the first place? And let's make sure that what you end up doing in effect is going to achieve that goal. Next slide. So after we have the grant, we have to then decide what are our vesting periods. And vesting means I can give you the right to buy 1,000 shares, but I don't necessarily mean that you're allowed to do so. And the vesting is, when are you allowed to exercise these options? I don't want to give you now options to buy 1,000 shares at any time in the next 5 years, all today, if really what I'm trying to do is get you to stay with me for 5 years. So I would say, well, each year you'll be entitled to exercise, let's say 20% of that. So I'm equally balancing your right to exercise your option over a 5-year period. And vesting is that. Vesting refers to when it is that you have earned the ability to exercise the option that we have previously granted to you. And these vesting periods, again, there's no pat answer on what's right and wrong. We need to figure it out for you and your company what these vesting periods will be. It's easiest to manage a time-based straight line vesting period. So as I said, 5 years or 4 years. You know, in 5 years, you get 20% each year. In 4 years, you get 25% each year, and so on. But there's no requirement. You can vest annually, semi-annually, quarterly, monthly, you know, hourly, for Christ's sakes, if you have all the time on your hands. So, you know, whatever you want to do. It's a matter of balancing out, again, that incentive you're trying to achieve together with management's ability to handle whatever plan it is that you have. With directors, consultants, you will often see a requirement that they fully vest upon completion of the project, or in the case of directors, upon completion of their term. Many directors will require upfront vesting because they are in a position where they don't control their own destiny, and shareholders can vote them off the island at any point in time, and they want to be entitled to their compensation or to their options as a result. So you will see certain parts of the plans that allow direct vesting. It doesn't need to vest even if you have it periodic. It doesn't need to vest in equal chunks. You can have it 10, 20, 30, 40% in year 1, 2, 3, 4, and you can have it backwards, again, depending on what it is you're trying to reward and what it is you're trying to motivate. So ultimate flexibility through all of these processes. Next slide, Irene. So now we've talked about, we've got our grants, we've got our vesting periods all established and so on. So now that you've got your grant and it's vested or vesting, how long do you have in order to exercise these options? They are not going to go on forever. And so your plan will talk about some set period of time that you have to decide whether or not you wish to exercise your option. And if you don't exercise within that time period, your option will expire. And again, it can be whatever you wish it to be. Now, these exercise periods I'm showing you here, which I'd suggest are relatively conventional. They're longer for employees than they are for directors and consultants. And they're subject to earlier termination, which we will talk about in a minute. But you need to be careful again on the motivation side, because if you give an employee the ability to exercise options for 10 years, but somewhere deep inside you've told them we're going to exit within 5 years, there is a disconnect here that may end up backfiring. And again, it comes back to what are you trying to achieve? But these are the general kind of timelines. Next. So we've talked throughout Jason's period that options are granted at fair market value. You do not need to grant options at fair market value. You can grant them at above or below fair market value. Valuation is always tough. Again, I alluded to that in my non-answer to the question earlier on. And once you do establish a price, it doesn't mean you're stuck with it. You can reprice your options. You can go, yeah, we granted options to everybody at $10 a share. We've done a pivot, or the company just didn't work, or things are really sluggish, or whatever it is. The value now is only $1 per share. That's what we're doing a financing at. How do I motivate my employees with $10 options when they're worth $1? So we can just sit there and go, you know, wave the magic wand, and presto, the option price is now $1. Again, not quite that simple. There may be some consequences, but in a private company, it's easy enough to do. So you're not stuck with that. So talking about the options at, above, below fair market value, if you issue options below fair market value, there is a tax issue, and I'll let Jason fill in a little bit more on that in a second here. Because you've got the immediate ability to make money, right, is the answer. If the stock's worth $10 and you let somebody buy it at $5, even if they don't buy it today, you've still got a $5 gain immediately. Jason, can you kind of share some thoughts on the taxation of below fair market value options?
Sorry, I just having some internet issues here. Sorry, what was the question again, Steve?
Just, we've got the concept of what's the tax consequences of issuing people options at below, with an exercise price below fair market value.
Well, if you're CCPC, there's you know, the taxation, the timing of the taxation of the benefits don't really change, but the 50% deduction is something that you may not get.
And so that gain that's embedded in there would be taxed as normal employment income, right?
Yes, that's correct.
Okay, and with a consultant or a contractor?
Then there's an intrinsic value there, right? So that would be kind of embedded into your stock option valuation. So, you know, if there's an intrinsic $2 gain there per share, that obviously increases the value of your options by at least $2, right?
And so that would be, you would need to pay tax on that kind of immediately because there's no deferral for those guys, right?
That's correct, yeah. So it'd be the same rules, but the value would be much higher in that case.
So, you know, we end up in a situation where issuing options below fair market value isn't necessarily all that advantageous to contractors. It's almost penal because you do have to pay tax. And if you end up selling those shares at a lower price, you get a capital gains deduction, not an income deduction. So you end up losing out all in all. So you got to be cautious, but it can be done from an accounting and from an option planning point of view. From a corporate governance point of view, you need to keep your eyes wide open because directors of companies are personally liable if they issue shares for less than what their value is. And if somebody is issuing options below fair market value or is issuing shares below fair market value, you need to ask yourself, why are you doing that? How do you justify that? Because the remaining shareholders are fundamentally getting screwed by the amount of that deficiency. So usually the answer you will get is, well, you know, we get to pay them less if we do that, or we get to pay them less if we give them lower options or shares. So then the answer from a corporate point of view is, aha, so, you know, you're not really paying them less, you're paying them less cash, but you're paying the balance by way of giving them these cheaper shares. And that again creates this whole regime of, if you're doing that, there is a tax, there's a benefit to the employee that will have to be taken into account. Okay, so I'm going to stop rambling on the below fair market value. And you can certainly issue them with an exercise price above fair market value. No problem with that, other than the motivation to your employee of going, you know, whoop-de-doo, I've got options to buy shares in my company that's double what it is today. So, you know, my motivation isn't really there. If that's not part of the reason for your plan, then it's less of an issue. But because of all of these things, you almost always see efforts being made to issue at fair market value. Okay, pause to catch my breath, take a look, see if there's anything there. No, okay, next slide. What class of shares do you have these options exercisable into? Again, up to you. Think about why you do it. I've just listed some, you know, common voting, common non-voting, preferred non-voting. One of the things that I suggest is the biggest mistakes of startups is creating a special class of shares for your option pool and having these, generally speaking, common non-voting shares as the equity being issued upon exercise of options. And you have founders come running in and saying, but I don't want my employees to be able to vote, you know, if they exercise these options, they can get the equity upside, but I don't want to hear from them. The reality of the situation is that there are certain circumstances where each class of shares has to approve certain decisions. And by giving the employees these special class of shares, they have the ability to veto certain decisions. And that's not a situation you ever want to get into, is losing control of your company to a group of people that you didn't want to hear from in the first place. It's really hard to persuade me that there is a reason to create a special class of shares for these people. The issue of having them vote or not vote is, remember that it's a majority rule environment we live in. So by issuing employees or others under a plan voting shares, the chances of them having sufficient equity to interfere with the decisions that the other shareholders want to make is slim. And to the extent that there is a concern, excuse me, a concern, it can be dealt with in a shareholders agreement or another form of agreement that deals with how one votes and how one deals with these shares. One of the other things to think about through that is, remember, by giving people options, you're giving them the right to buy shares. If they buy shares, they are then a shareholder. What happens if an employee becomes a shareholder and then you fire that employee, or that employee quits and goes across the street to the competition? Remember, you've got shareholders who are bad guys in your books of good guy, bad guy list. And preferably you will have in your plan, or you will have in your shareholders agreement, the ability in order to buy shares back in those circumstances. Next slide, Erin. So we've talked about having a 5 to 7 year or 5 to 10 year vesting period in order to deal with the expiry of these options. There will be circumstances where you're going to want to shorten that time period. Again, for example, if somebody is fired because they have stolen from you, their option should terminate immediately. Okay. If you're firing them for other reasons without cause, so they're no longer the employee and so on, they need a reasonable time period in order to decide to buy in or not. And again, kind of my rule of thumb is about 90 days. It can be whatever you want. If somebody retires so that they're not running off somewhere else, you can give them a longer period of time, maybe up to a year, but again, going on longer is tougher. Disability or death, for example, we tend to be more lenient and allow people a longer time in order to exercise those options. But eventually they all need to come to an end. And if the beneficiary of these options is no longer working for you and is no longer contributing to the growth of the enterprise and the success and the increase in value, this time period needs to be shortened. And most importantly, perhaps, is if you sell the company, you need these options to expire. You cannot sell a company to somebody hoping that they get 100% to have them turn around and realize that there's somebody out there who has options that can be exercised into the future. And so that purchaser does not know or understand that they would ever be able to get 100% of the company. To not have that in there is tough. Okay, next slide. So we've been carrying on our business. We've got a 5-year vesting period. So each year that I'm with you, I get 20% of my options vesting. What happens if the company is sold in year 3? Okay, I've only got 60% of my options vested. So the answer to what happens will be, it depends what your plan says. So you can have provisions which vest all unvested options. So I now have the ability to exercise all my options and buy that chunk. You can accelerate by 1 year, you can accelerate by more, you can leave it as it is, or you can have what I call selective acceleration, which means the board retains the discretion on what to do in the event of a change of control. And I use the phrase change of control rather than sale of the company, depending on, again, what you're trying to achieve and how important it is that people are working for you or for others. This threshold could be less than a simple change of simple sale of the company. Okay, next. We've given people the right to participate in our plan in order to buy shares in our company. Generally speaking, to motivate their behavior while they're within the company and to motivate them for doing a good job. If that's what we're trying to achieve, we will not allow these options to be transferred. The last thing you want to do is give your CTO a pile of options for developing your code and then have them turn around and give it to me because I gave them $1,000 or a ride in my car. It just, you lose the complete impact of what it was you were trying to achieve. If, on the other hand, these options are compensation, you may decide, well, you know what, maybe there shouldn't be restrictions on the ability to transfer them because this consultant or whoever it is, instead of paying him $100 grand in order to do something, we've given him these options. If he can turn around and sell them, maybe you should be entitled to do so. Again, it all comes back to the start. What is it that you're trying to achieve through the grant of the options and through the ownership of the shares upon exercise of those options? Maybe we have limited restrictions somewhere up the middle where you're allowed for planning purposes to transfer to a family trust or to transfer to somebody else within our organization, so at least we don't have outsiders. Again, myriad of choices on what to do here. Okay, next.
Steve, there is a question. And the question is, can you outline the distinction between founder shares and these classes of shares? I think it should be these classes of options. But
yeah, for sure. So, you know, and I think, Irene, your clarification of the question is a good place to start. And that's, and founder shares are just a fancy word or a phrase that has been coined to describe that group of shares that are issued to the founders at the very beginning of the company for next to nothing. Okay, it isn't a class of shares. There's nothing magical about it. It's just that package of shares, whatever the hell it might be. That's what founder shares are. Founder shares, however, having said that, are almost always plain vanilla common shares. Okay, that's it. And you almost never see anything else. If you do see anything else, they will probably be changed to plain vanilla common shares by the time your investors get done with it. So we can assume that. Okay, options, again, are not a share. They are a right to purchase a share at some point in the future. So what I talked about before on the classes of shares that one can buy, and I think that's when that question popped up on the screen. The shares that are subject to a plan can be anything. As I suggested, will almost always be just common shares. So the technical answer to your question is there is rarely a difference between the shares that one gets on the exercise of an option and the shares that the founders hold. And if you wanted to come back and try to rationalize or justify that, my answer to you is, and that's the way it should be, because we want alignment between the founders and the beneficiaries under a plan. We want them working towards the same goal. We want them to benefit in the same manner. We want them to share pro rata on that ownership and so on. So I don't know if that answered the questions, but you know, the founder shares are the shares that founders get at the beginning of their formation of the company for next to nothing, that they will hold until the company is sold. And the option shares, or the shares that are issued upon exercise of the options, are the shares that the option holders end up buying for whatever price per share the option grant allowed them to buy.
Okay. Next slide.
So we can go to the next one. There we go.
I did. There you go.
So I talked before that just because you've given somebody an option doesn't mean that deep down inside you want them to hold your shares for all of time. And so there are ways to deal with the ability of these shares to be transferred. But again, remember, we're talking about once an option holder has exercised an option and bought shares. So I'm now out of the option and we're into the shares. We're past the grant, we're past the vesting, we're past the exercise, and we now own shares. So these people, the beneficiaries under the plan, are now shareholders just like any other shareholder. And as I mentioned before, you're going to care if some of these people go off and work for a competitor. They get your financial statements. They have the right to attend at a meeting. They have the right to be an asshole. Okay, these things you may wish to change as you go forward. As I suggested before, the easiest place to do that is likely in your shareholders agreement that all shareholders sign, and it will be a precondition of your plan that if an employee is going to exercise an option and acquire a share, that they must enter into a shareholders agreement. Okay, the shareholders agreement, again, you can deal with these repurchase rights in many ways, but some of the things you're going to want to make sure that they're bound by is the fact that if they go to sell it to anybody, you have first dibs, that they don't have the ability to interfere with your sale of the company, that they're going to maintain confidentiality, and that it doesn't in any way impact voting control. Okay, all of these things are as important, I'd suggest, as the terms of the grant themselves. Next. Okay, so we've got this great plan. We've done everything. We've customized it so that it works for you. I just parenthetically want to go. It doesn't cost a whole lot more to create a customized plan for what you need than it does to take an off-the-shelf plan that does nothing. You know, we're talking about, you know, a series of like 10 items that you need to decide how it's going to work, and then it all comes together and it's fine. So it's back to the if you don't like something that's in the plan you're looking at, change it. But now we have the plan, so how do we administer it? And these plans can be administered by your board, it can be administered by a comp committee, it could be administered by others, such as your director of HR. Many of you are probably sitting there going, hey, wait, I am the board, I am the comp committee, I am the director of HR, so I guess it's me. That's all fair. And as the company grows, you need to go through these processes. Remember, again, back to corporate governance, that only the board can issue shares. So only the board really can delegate these options, but they can delegate that whole process to somebody else. All right, so it starts with the board. Your resolutions, when you create the plan, will say who it is that gets to deal with some of these aspects of administering the plan. But if you have a complex plan or even a simple plan, please make sure that whoever you are resting the authority with in order to deal with these things does it right. Okay, please make sure that whoever is entering into employment contracts on your behalf with a variety of people and are saying, and you'll get options as part of your employment, that employment contract has been properly vetted by an employment lawyer so that you know what's effective and what isn't, and that you diligently fulfill your promises to your employees through the grants of these options if you have done so. We see quite often people coming in and saying, well, we told the employee or my consultant that they get, options for 2% of the company, but we never got around to doing it. And it's like, so what does that mean? Does it mean that they get to sue you for it? Does it mean you have to give them 2% as it was then or 2% as it is now? Or, what's the exercise price? All of those open-ended issues that are going to cause you great consternation are all part of this administration of the plan, and have it with somebody who can do it and get it done right. Okay, next slide. So we're growing, and rather than doing the M&A exit scenario I've been talking about endlessly, we decided to go public. Again, make sure your plan addresses that. You need to have a plan that contemplates an IPO and allows the board to amend that IPO as necessary. You will find that your pool will shrink as a percentage of capital as you issue more shares. And again, just rough numbers, depending on which exchange you're listing on, all sorts of different thresholds on what it is that you're allowed to have. So you just need to make sure that the flexibility is built in order to allow your plan to function as part of an IPO. Where you don't want to get to is to have a circumstance, Irene, if you can switch to the next slide, where you have a circumstance where you're going to need to go to your option holders in order to get permission to do something that you need to do. Which brings us to the concept of how do you amend the plan? Your plan, like any other important agreement that your company is subject to, should be reviewed. I wouldn't say on an ongoing basis, but it should be reviewed at least annually. And depending on what you are finding, you may want to make some changes to that plan. So, how often do you change it? Again, periodically, meaning whenever you feel like it, is perfectly fine answer. You will want to amend it upon going public, as I talked about. And there may be some employment issues that you're going to deal with if you unilaterally amend the plan. I'm not going to give an employment law lecture here, but if options are part of an employment contract and you negatively change the impact of a stock option through an amendment to your plan, it could constitute a change to the employment circumstance and constructive dismissal, and you want to avoid that like the plague. Next. So we've got the plan, we've got everything set. We know as management and the board and so on what we're going to do. How do we share this with our employees? How do we roll out our plan in an established company or a new plan? Here again are just some numbers, but you'll see, probably 3/4 of the companies use a letter to their employees, consultants, and so on what the option plan is and how it works. About 60% hold group meetings, about 60% hold individual meetings. Obviously, what you will see from the mathematics is that most companies actually will end up doing more than one thing. You will see generally a letter and then a meeting to follow up in whatever format they use. Again, punchline at the bottom, a few companies really have a well-developed communication plan to explain to employees and what the plan is, how it works, where it's at, and so on, with the result that most plans are not understood by employees. I just want to, again, make one comment through not just kind of twigs from the communication plan. When we're starting up a company and people ask how many shares should we have, you know, my answer is generally, you know, somewhere in the neighborhood of 6 million shares amongst the founders, because that leaves lots of room to do lots of things, and it cuts the pie into a really nice, a small number of slices. When there's 10 shares in a company and your company is worth $1 million, you know, each of those shares is worth $100,000 bucks. So how do you give an option to somebody to buy, you know, shares in your company? How do you motivate your staff when they either go, oh, in order to buy my one share, I need to come up with 100 grand, or even worse, you know, if you're going to give options, you can't give it for less than one share. So how many of these can you give out? And ironically, the other aspect of it is your employee goes running home and says, hey, I got an option at work. And, you know, be reverse sexist here. The husband says, oh, that's great. How many options did you get, honey? And she says, one. And he goes, oh, yip-de-doo. And, you know, Johnny's wife down the street, she got 100,000 options. It means nothing, okay? But it completely impacts on the psychology of these plans with your employees. And if you've developed a proper plan, you know, following the questions and the issues that we've discussed here, and going through the motivation, always keeping in mind those first questions, why are we doing this in the first place? You will see things like numbers, investing periods, and dates of grant, and all the rest of that are going to fall in place and get you to the right spot. And then it's a hell of a motivational tool, folks, and take advantage of that and make sure your employees understand what it is that you're getting.